All right, let's cut right through the market noise and get straight to the numbers. Welcome to today's explainer. We're running a complete corporate health check on Korn Ferry, ticker symbol KFY. The goal here is simple. We're going to take Korn Ferry's massive, honestly somewhat overwhelming stack of financial metrics and distill them down into a clean, easy-to-read dashboard. By the end of this, you'll know exactly what's actually going on under the hood of this global consulting powerhouse. To anchor everything, we've got to start with the current sticker price. Right now, Korn Ferry's last closing price is sitting at $63.80 a share. Now, obviously, on its own, that number doesn't tell us a whole lot, right? It's literally just what the market happens to be willing to pay on any given day. To figure out if it's actually a deal, we need a baseline.
And here is where things get super interesting. When we compare that current market price of $63.80 to the calculated intrinsic fair value price, which sits at $83.16 based on discounted cash flows, we uncover the central mystery of this explainer. Is Korn Ferry fundamentally undervalued right now, or is the market sniffing out some hidden risk that these valuation models are totally missing? Let's dig in and find out.
To keep us on track, here's our roadmap for the data. 1. The KFI snapshot. 2. Is the price right? 3. Profitability and growth. 4. Dividends and returns. And finally, 5. The big picture.
Starting right off with Section 1, the KFY snapshot. Let's get a feel for their current market position.
So, Korn Ferry is a mid-cap player with a $3.31 billion market cap. But lately, they've been sailing into some headwinds. The stock is actually down about 2.5% year-to-date. More importantly, it's currently trading almost 19% below its 52-week high of $78.50. So we're definitely looking at a stock that has cooled off in a major way from its recent peak.
Moving right along to Section 2. Is the price right? Look, just because a stock dropped doesn't automatically make it cheap. Let's check those valuation metrics.
Well, the numbers paint a pretty clear picture here. Whether you look at earnings, sales, or book value, KFY is trading well below its historical averages. Check out that price-to-earnings ratio at 12.63. That is a solid 13% discount compared to its 3-year average, and a 15% discount against its 5-year average. Price to sales at 1.15 and price to book at 1.64, they are telling the exact same story. The market has absolutely tossed this stock into the discount bin relative to its own history.
Now, before we look at the final valuation score based on cash flows, let's quickly touch on a crucial concept, the margin of safety. Essentially, this is your buffer. It's the difference between the price you're paying today and the true intrinsic value of the business. You know the drill. The larger the margin, the more cushion you have if things go south.
And factoring in that fair value estimate from earlier, Korn Ferry is boasting a really generous margin of safety right now at 23.28% based on free cash flow. Think about what that actually means. Mathematically, you're buying the cash generation of this entire business at nearly a 25% discount off its calculated worth. Not too shabby at all. Okay, on to Section 3, profitability and growth. We know the car is cheap, but is the engine actually running? Let's pop the hood. Good news first. The profitability metrics are incredibly robust. They're operating with a massive gross profit margin of over 88%. But the real star of the show is that net profit margin at 8.96%. Why? Because that net margin has surged nearly 22% compared to its own 3-year average. Throw in a return on invested capital of almost 12%, and it's obvious management knows how to allocate capital efficiently. But here's where we hit some turbulence. Growth is definitely a mixed bag right now. Look at the last 5 years. Net income has grown at an absolutely stellar 41% annualized rate. However, when we zoom in on the trailing 12-month free cash flow, it's actually shrunk by almost 9%. So while the accounting profits look incredible over a 5-year stretch, the actual hard cash hitting the bank over the last year has undeniably slowed down. This is absolutely the first major red flag on our dashboard. Which brings us to Section 4, dividends and returns. The real question is, how does all this operational performance actually translate into cash payouts for you? If you're an income investor, you're going to like this. Korn Ferry rewards its shareholders with a very healthy 3.45% yield. And remember that shrinking cash flow we just flagged? Well, the good news is it hasn't threatened the dividend at all yet. Their payout ratio is rock solid at just under 39%, which means they are keeping plenty of earnings in-house to run the business. On top of that, they've hiked this dividend for 5 years straight. But honestly, the yield isn't even the craziest part. It's the speed at which they are growing this dividend.
Look at this. Over the last 3 years, they've pushed a massive 54% annualized dividend growth rate. Even on a 5-year timeline, it's growing at almost 38% a year. It is crystal clear that management is highly focused on returning capital to shareholders, and they're doing it fast. So, how has the market rewarded that strategy over time? When we pull back and look at the historical returns, it's definitely a tale of different eras. If you bought exactly 5 years ago, your return is basically a flat 3.29%. Ouch. But step back a bit further, you've got a 42% return over 3 years, 162% over 10 years, and a massive 283% return over 20 years. Basically, KFY has been a huge wealth generator, provided you have the stomach to endure those flat periods along the way. Bringing it all home to Section 5, the big picture. Let's synthesize all these data points into one final diagnostic. When we lay the whole dashboard out objectively, we've got a really interesting balancing act. On the strength side of the ledger, you're looking at a highly attractive valuation, a PE of 12.6, a 23% margin of safety, and a fast-growing 3.5% dividend yield. But on the flip side, we can't ignore the headwinds, that recent dip in share price, and crucially, that nearly 9% drop in trailing free cash flow. It's obvious the market is currently weighing this dirt-cheap price directly against that slowing cash flow generation. So, after running this complete system check, I'm going to leave you with this final thought as you do your own research. Ask yourself, does a 23% margin of safety and a rock-solid growing dividend outweigh that recent decline in cash flow for your portfolio? The data is all right there on the table, but how you weight it is entirely up to you. Thanks so much for joining me on this explainer today. Keep diving into those numbers, and I'll catch you on the next deep dive.